to the newest episode of Reclaiming My Mind. My name is Jessica Vaughn. I'm the host that you're most familiar with, but as many of you know, we have had a co-host for some time right now. Kin Cook has joined us. Thank you so much, Kin, for helping with this podcast. And today we have a really interesting episode prepared for you. But I'm going to go ahead and pass it over to Kin, who's going to do a majority of this interview, and I'll chime in with some questions. But Kin is the man for this. So Kin, take it away.
All right. Thank you, Jessica. As all of you know, Jessica is, of course, the host for Reclaiming My Mind podcast. She's mother to a wonderful, talented son, Zach, and teacher. She also was past president and co-founder of Democratic Progressive Caucus of Tampa Bay. And since she didn't have enough on her plate, she's running for a seat now on the Hillsborough County School Board District 3. So I certainly encourage any of you in District 3, please vote for Jessica. I think it'd be an excellent choice for this position. In addition, today we have two guests. Dr. Scott Ferguson, he's Associate Professor of Film and Media Studies in the Department of Humanities and Cultural Studies at the University of South Florida. He co-directs the Modern Money Network Humanities Division and serves as a research scholar at the Global Institute for Sustainable Prosperity. His book, Declarations of Dependence, Money, Aesthetics, and the Politics of Care, was published by the University of Nebraska Press in 2018, and he hosts the Money on the Left podcast, which is published monthly by the Monthly Review Online. Scott has been on our podcast before discussing modern monetary theory and was very informative. Thank you for being here. I'm really looking forward to an interesting discussion today.
Thanks for inviting me.
Oh, it's our pleasure. We also have with us Dr. Benjamin Wilson. He's an associate professor of economics at the State University of New York College at Cortland, which is a mouthful, so we'll start calling it SUNY Cortland further. But his research interests include environmental health, food systems, modern monetary theory, and he teaches courses at SUNY Cortland in microeconomics, comparative economic systems, urban economics, as well as a political economy of the Adirondacks class that takes place at the university's camp. In addition, Dr. Wilson is currently a research scholar for the Global Institute for Sustainable Prosperity. His research programs and teaching inform a policy agenda that seeks to improve the healthcare provisioning process within the context of other modern monetary theory, consistent proposals such as the Green New Deal and a jobs guarantee. So, Ben, thank you very much for being here today. We certainly appreciate it.
Yeah, delighted to be here and a pleasure to meet both of you.
Now, our topic today is going to be, COVID-19 impact and Municipal Liquidity Facility, which is a program which we'll be discussing shortly. But we generally like to get to know our guests a little bit better, other than just your bios. Maybe you could tell us a little bit more about who Scott is and who Ben are. Scott, you want to start?
Sure. So I grew up in the suburbs of Los Angeles. I actually grew up as a professional actor in Hollywood, which I don't really think about very much anymore, but those are my roots. And then I got into film and media study as an undergrad and then grad student when I went to UC Berkeley to get my PhD. And then I ended up at USF teaching film and media and culture. But then increasingly, I became interested in questions about money and economics and how film and media and economics interrelate. And then I got to know people like Ben Wilson, my co-guest here, and starting to really help to work on how we can reorganize our economies in new and more just ways away from our contemporary kind of private profit centered systems that we have. At USF, I teach fun intro courses about film and media. We watch Citizen Kane and Netflix shows and do all that kind of stuff. But I also teach more challenging courses where we take on, kind of big economic ideas and bring them into relationship with culture and media and that kind of thing. What else can I say about myself? I'm a dad. My partner is also a professor at USF. Our kids go to school in the Hillsborough County School District. I think I'll stop there.
Well, that's good. That's enough. And Ben, how about you? Tell me a little bit more about you.
Sure. Well, I guess educational background wise, I did my undergraduate at the University of Kansas in what would be considered orthodox economic training. So supply and demand and marginalist thinking, a lot of mathematics and those sorts of things. Through the course of life, I ended up leaving the academy with a master's degree and ventured into the private sector for a while, doing some quantitative research at a marketing firm, and then ending up in retail banking, which is really where all of my research agenda kind of began. Seeing balance sheets and the way that the financial industry works at really the bottom of the totem pole, right? Our everyday transactions and banking and basic lending such as home mortgages and car loans and credit cards and all of these products really started to make me think about how money works in our economic system and how it doesn't work. And that the light on how it doesn't work really got shined brightly as I started working more with the Community Reinvestment Act office at the bank and venturing into communities that the banking sector likes to call the unbanked, right? The people that they don't have checking accounts or products with. And in Kansas City, where I was living at the time and where I was really raised, these were often communities of color. And because I had learned how to speak Spanish as an undergrad, I was teaching financial literacy courses to largely Latin American communities. And so from there, I started to make connections with community organizations and activist groups, specifically around housing quality and healthcare. And it really rejuvenated a desire to think about economic growth and development. And I ended up going back to school in Kansas City at the University of Missouri, Kansas City, to study political economy, which is a much broader, richer investigation of economic analysis. And this is where I was introduced to modern monetary theory and a host of other, really great philosophical thinkings in terms of, how we approach science and what it means to investigate and what the economy really is, and thinking deeply about what value theory is all about. And completed the PhD program there with a research agenda around local food systems and how, stabilizing communities through local foods, such as urban gardens and community-supported agriculture, does many things to help a community in terms of education and healthcare and crime reduction. And I've picked up on that agenda here in central New York. The Finger Lakes region is absolutely beautiful. Coming to, they say that people on the coast don't really understand the Midwest. Well, coming from the Midwest, I didn't really understand all the beauty and splendor that New York State really offered. Lakes, farming, diverse food systems, lots of history. And so I've been working, Cortland is a rural, post-industrial community that was hit hard by, the last several decades. The prominent industry in Cortland in its heyday was typewriters. So not a whole lot of typewriter sales these days. So we're doing local food stuff for economic development and growth. And at the heart of that for me is thinking about local currency systems and diversifying monetary flows to support agendas outside of the standard profit method.
Well, it's obvious that both of you are very involved in the community and involved in what's going on. So thank you for that, Ben. I appreciate it. Our topic today, really, I would like to get started by quoting a little piece from the Tampa Tribune. It was an article that was published April 14th. And it goes just this quick little bit from: the Hillsborough County School District worked for years to fix its finances. It spent months after that selling voters on a tax hike for air conditioners and other capital needs. Despite that hard work, the district's critic could suffer because of expected losses from COVID-19. On Monday, Fitch Ratings Incorporated announced it was downgraded some of the district's outstanding bonds from AA to A+ and revised its financial outlook from stable to negative. This means the rating agency, one of three, watched the district on behalf of lenders, says the district is not as attractive for investments as it used to be, which in turn can make it more expensive to borrow money. So this is just kind of this is certainly not the only district or the only governmental agency that is being affected by COVID-19. And I'd like to kind of just start the discussion here so that our people understand what COVID-19 and the financial consequences and why this program we're talking about is important. So Scott or Ben, can you kind of give us a synopsis there?
Scott, you want to lead the way there?
Well, yeah, I want to do some laying of some ground first, right?
Okay.
So the point of view that Ben and I work from, this modern monetary point of view, understands that money is not simply a private exchange instrument that passes around in the business community. It is that, but it's so much more than that. And what it ultimately is it's a public utility that belongs to the public and should actually serve the people. So that's number one. Number two, the modern monetary theory argues that as a public utility, the government, and especially the currency issuing government, in this case, the federal US government, can never actually run out of money. It makes the money. It can always spend more money. It can run out of resources. It can run out of labor. It could not have technology or social know-how, or it might need to educate certain people and train them to do certain things. But the federal government and every institution, bank, municipality that sits within the federal government can actually afford whatever is needed as long as we can materially and socially mobilize resources to do so. So the upshot of that for regular times and for extreme pandemic crisis times is that austerity is a political choice. It is never inevitable. That doesn't mean we resting as we have, but it means thinking about what needs to be done and allocating money for the purposes of getting that done. So if we need to shut down the service sector to meet stay-at-home orders and keep our communities safe, that is going to create a major recession there, right? But then that means that from our point of view, we should be spending at federal, state, and municipal levels to make sure that those people are taken care of, right? That they're still on payroll, that they're still or hopefully getting medical care, right? So that's the broad perspective that we come to. And then more specifically, this crisis. Yes, it is true. Tax revenues are dropping like mad, and projected revenues are dropping like crazy. But that doesn't mean that the response should be cutting budgets. In fact, if you read a little bit of John Maynard Keynes, he'll tell you that the worst thing you can do during a recession or a depression, especially for the public sector, is to cut funding, because all that does is deepens the depression or deepens the recession. Now, as we all know, Congress has done what seems like a lot through the CARES Act, but it's not adequate, as I think many of us understand. They've been kind of sitting on their hands for months and months and months, not doing anything more than that CARES Act. All kinds of protections that were inadequate are running out, right, as we speak, threatening millions and millions of livelihoods and the safety and health of our communities. And at the same time, politically, what has been happening is that the Federal Reserve, which was very slow to act during the great financial crisis, has learned their lesson to a degree, and they were ready to go as soon as this pandemic and its economic consequences became clear. Now, they are no heroes. They're not, for the people, right? They still are very much serving big business and big finance and those interests. That said, they are acting much more responsibility within their mandate and actually experimenting and pushing the envelope well beyond their kind of conventional mandate in order to help stabilize the balance sheets, which means, basically making everybody liquid, right? Making sure that not all, but many critical institutions, from big businesses to small businesses, and even states and municipalities, right? Making sure that they're kind of okay so that they can actually deal with this crisis. This leads to some new apparatus that they've created called, as you put it earlier, the Municipal Liquidity Facility. It sounds like a bunch of mumbo jumbo, right? If you don't follow this stuff, you don't read the finance journalism, like what the hell is that, right? So it's for municipalities. It's to provide liquidity, right? It's to provide credit. It's to provide money, essentially, so that states, counties, cities, and even other public infrastructure, including the MTA in New York, can stay whole financially in order to greet this crisis with the kind of robust spending that it deserves. So that's how I'll set the stage, so to speak, and then maybe we can kind of go from there.
Yeah, I think just to clarify a couple of the things for the listener on money and Scott's really excellent rundown and framework. I mean, at its most basic level, money is a promise to pay or an IOU, right? So, when he's talking about real resources and our ability to meet those promises, right? The line that you read, right? The school district is spending lots of time and effort on their finances, right? That's not what the school district is there for, right? The school district should be there working and spending its time and effort to meet the needs of its children and deliver high quality education. But we've structured our financial system, right? We've designed the way in which we think about our promises in such a way that we really are limiting the public sector. And this is really a process of political design and change that has not always existed. It's a process that has taken the course of several decades, really the beginnings of which begin in the mid-1970s and are just increasingly becoming more and more stringent. And I think, Jessica, I think you've probably observed this in your role as a school teacher, and Scott and I have certainly observed this in our role in higher ed. All of these administrators and people in leadership at various levels are always waiting for somebody else to make these balance sheet decisions, et cetera, on funding.
Absolutely.
And this really limits the speed and ability for us to respond. And one of the things, building on Scott's point about the Federal Reserve, is that they recognized that by delaying response and by being slow in providing liquidity or cash flow to the economy, they deepen the recession. And by deepening the recession, they make it more painful. And its time frame lasts longer. And this is going to be a much more painful and long-lasting recession because this isn't just a financial crisis. This is a health crisis that is exacerbating and leading to a financial crisis. So we're experiencing a much more widespread balance sheet stress, right down to our own households, right? As 40 million Americans have already lost their jobs. That's a number much greater than what we experienced in 2008. And so, what modern money is arguing for is really a restructuring in these institutions and a restructuring in the way that these monies are being allocated. And the Municipal Liquidity Facility is basically a tool for helping to generate that. Instead of having to wait for Congress to get home from recess and get back to work, states and local governments can issue and start getting cash flow going. And then the political fight can proceed from there, right? If we want the federal government to buy those or forgive those. But this begins a much broader discussion about, the money is always there. The money is available, and how do we respond to and meet the needs of our people in a real resource-driven, focused way, instead of focusing first on finance and then trying to solve all of our problems, right? At the end of a very interesting piece in the New York Times about education, The Big Mess, the final line is you can see what they value, speaking of politicians, by what they spend their money on. Well, we should be spending the money on what we value, and it'll make our lives much richer, safer, and fulfilling.
So I have a question in regards to that, if I can just jump in for a second. What if everyone values something different? I mean, it seems like one of the issues is we can't even get a consensus on whether we value public safety by wearing a mask at this point in this country. So how do we come to a consensus of what we value when it comes to education even?
Well, I think part of the reason why we're having a hard time with that discussion is because we're framing it within the context of what we can afford, right? And this mythological space that really what neoclassical economics and what this conservative view of the economy, where we have to take from the economy to give to the public sector in order to do things for the public, really creates, is problematic. I mean, that's not the world that we actually live in. And it creates a false duality between public health and the economy. So we've got to choose to either open up the economy to save the economy, or we've got to choose public health. What we're saying is that that's not what the choice is. And so if we all understood that we can do good public health and have a strong economy at the same time, then I think a lot of that disagreement falls away.
So can I say that, to kind of sum it up, that we're framing our values within the economic constraints that we have, as opposed to placing our values first and then looking at how we need to fund those values to prioritize things. Is that kind of what you're saying?
I think that's a really straightforward way of saying it.
Okay, thank you.
You should visit my class. My students would appreciate it.
And just so we're all clear here, the Federal Reserve has been pretty forthright this time around in terms of public statements about what they're capable of doing.
Uh-huh.
On the one hand, as I said, they're imperfect, right? And they need to be pushed further. But for example, the Minnesota Fed Chair, Neil Kashkari, is on record. You can Google it right now, or use a less corporate search engine right now, and find his quote where he essentially says something like, the Federal Reserve has an infinite amount of cash. It can go to infinity, right? So our argument to Hillsborough County and to the Hillsborough County school system would be, why would we not take advantage of that? Why would we not politicize that to do good by our communities and our kids?
Good question. I think that's what we're hoping to explore today, right? And get more into the meat of that.
Well, it's a tough, really hard transition, right? When I start to expose this reality to my students, and I ask the question, what do you want, right? What would you value? What do you see? The disciplining that we've all been beaten down with in terms of our political debates really narrows the imagination. It makes it very hard to have a discussion and break free from the language that's being used in the discussion of higher ed's budgeting, is that the administrators have a playbook, right? There's a very standardized approach to thinking about all these problems. So you can only imagine what is already written down in this playbook. And so to break free from that is challenging. And for me, I think that's one of the great contributions that Scott and the Humanities Division of the Modern Money Network is making, is that it's beginning to open up that space for people to think much more broadly and to imagine the world outside of this very constrained neoclassical economic sort of point of view, all of which is derived at its base inside a Cartesian plane, right? None of us get dressed in the morning for work or to help our families in a Cartesian plane, right? It's a model that takes place in logical time, not historical time, and in mathematical space and not in the three-dimensional world that we all live in. So it's time to think much bigger and broader about all of these things.
But, I think this crisis is really forcing them. I think it's forcing us and making us understand that the systems that we currently have are not working. They're not adequate. I mean, my educational background was in finance a long time ago, much longer than you guys. And certainly what I was taught is baseless in our current economy. So Scott has helped me open my eyes a little bit to the modern monetary theory and how it actually describes the real world much better and more adequately. So, this crisis, though, again, we're facing in most people's minds is, frankly, there's a shortage of money. We're not going to have the incomes coming in. Individually, people are out of work. So how are municipalities going to get taxes? How are they going to get the revenue that the older model really generated? So let's talk a little bit more about, though, the Municipal Liquidity Facility and specifically about that. Can y'all kind of give us a synopsis of what it is and why it's been implemented and how it works?
In 2008, the financial crisis was a balance sheet crisis, right? As home mortgages began to fail and the prices of housing began to drop, all of the assets that were backed by home prices began to fall in value, and we have a big sell-off. And in order to meet their solvency liquidity requirements at the end of the business day, the bank can sell off or borrow from other banks at what the Federal Reserve sets as its overnight lending rate. But if none of the banks know which one is holding the assets that are falling to zero in value, none of them want to lend to each other because their collateral is probably not good and they might not be open tomorrow. So in this situation, the Federal Reserve traditionally has what's called the discount window, where the bank can go to that window and borrow as a lender of last resort in order to maintain its liquidity overnight so it can open up for business the next day and hopefully sort out their balance sheet problems. In the banking world, if you go to that discount window, it's a pretty clear signal to the rest of the world that you're in trouble. So that stigma makes it very hard for you to continue, even though you've kind of made things right overnight. So recognizing the systematic nature of the toxic mortgage-backed security crisis, the Federal Reserve opened a series of what they called lending facilities. And these facilities played the role of the discount window, but they removed the stigma of using those facilities. And the Federal Reserve brought these banks in, and there's the images are still floating around the internet of all these big bankers sitting around a big table with President Obama and Timothy Geithner and other leaders at the Federal Reserve, Ben Bernanke, et cetera. And under this situation, one of the things that they did was they issued cash onto the bank's balance sheets in exchange for huge sums of these mortgage-backed securities at prices that would have carried during normal economic times. So it's a completely negotiated number led by the banks themselves. They came out, I believe the early number was something like $1.8 trillion. Right. So cash for assets that were worth zero in value in order to stabilize the financial sector. And then they kept these facilities open to varying lengths of time and degree of trading over, the past 10 years since the Fed. And if you want to check it out, it's really quite a spectacular graph. The Cleveland Federal Reserve posts its balance sheet. So you can track the purchases of securities and other assets that the Fed is making, not only back in 2008, but currently. And the balance sheet, of course, is exploding once again with a lot of mortgage-backed securities again this time around. But instead of waiting, so it worked, right? The Federal Reserve stabilized the balance sheets of the banking sector, and we had what was called a jobless recovery, if you remember that rhetoric. Kind of an oxymoron, if you ask me, right? How can you recover without jobs? So no surprise that the recovery was hugely skewed in income distribution to the very top. Recognizing this, and this is what Scott was alluding to earlier in the show, right? We have this massively unequal recovery that didn't really do a lot of good for a lot of people. Lots of people still lost their houses. Lots of people lost their jobs. Lots of people in public institutions like school districts and institutions of higher ed are still kind of weakened and recovering from this crisis. And so recognizing that, the Fed opened a new tool, a similar tool for states and municipalities to stabilize their balance sheet. But, instead of, so there's some serious weaknesses with the way that this is set up because it's the first time they set it up. I think one of the things that the Fed is being good about is that it acknowledges that it's experimental. Everything that it does, especially in times of crisis, is being made up as they go along. And so they've been willing to negotiate and adjust these terms and conditions for the financial sector. And in the most recent iteration of these facilities, the Main Street Lending Facility, for example, they've bent over backwards for fossil fuel companies, insurance companies. They've recently purchased a bunch of assets from automobile manufacturers, even Toyota, to stabilize their balance sheets. So to think that states, municipalities, institutions of higher learning, systems of higher learning, school districts can also organize and leverage liquidity stability through this mechanism to make it through the crisis and really do a much better job of saving jobs, right? Because school districts, universities, municipalities, right? These are direct job creators, whereas the banking industry is not, right? There's a lot more paper than people in the financial sector, right?
So this facility, as I understand it, essentially opens or builds a market for say the school board or other municipalities, other entities to really sell their bonds, their issues, stock issues that they would generate normally that the other markets would take care of. But now the Feds have essentially stepped in and said, hey, we'll buy them. Okay. You can either put them out at a public type sale, or we'll just buy them all to be able to allow them to generate the funds that they need. Correct? Is that a kind of a synopsis or a kind of a layman's terms of what they're doing?
Yes, that sounds spot on.
So I have some questions.
Yes.
For people, because this is all great, but it's very high level. So for people who, are just really even starting to think about like our budget and the school board or municipalities and how it affects us, okay? I'm coming from the mind frame of, your average working voter who hasn't really had a lot of time to even think about how municipalities are funded or the tax allocations or any of that. So let's start off in my mind. I'm thinking so far been away from where you guys are even at, but why are municipalities taking out loans to be funded in the first place, right? If you're a typical worker, you start to think that a budget comes from whatever revenue you have, the taxes that you've allotted to it. You work from within that budget, and then you grow exponentially based on, the money that you're taking in. So when we're talking about bonds and borrowing money and rating in the first place, as kind of your average voter who doesn't even understand the budgets, I mean, I don't think people even understand why municipalities are taking out money, how they're borrowing, what bonds means, the fact that they have their own credit rating, how that affects things. So when we're talking about, finding out huge deficits, if we're trying to educate voters on the fact that there might be better alternatives to borrowing money and how that can affect us, I think we need to first talk about why we're borrowing money and what that means at the municipal level, personally.
Yeah, there's a lot there. I mean, I'll take part of that question. Right. So part of the answer to that to that question is that the reason that public school districts are selling bonds to the private sector, to secondary bond markets in the first place, is because there's not enough public funding directly coming from the different levels of government in the first place. And this is, as Ben has suggested, a political and legal design, not something that's inevitable. So, as we've been arguing in some of our chats prior to this public conversation, we've been saying that, yes, school districts should not be issuing bonds to finance themselves through the private sector. All that does is enriches the private sector and puts public school systems in a kind of passive supplicating role that is beholden then to the private sector and bond rating agencies, et cetera, et cetera. Ben, do you want to take over from there?
I would say that the reason that they're borrowing or the fact that they're borrowing is evidence that the system is broken, and that we're approaching the problem from a completely ill-founded foundational concept, right? So one of the things that economics and standard economics does is it reduces everything down to individual choice. Right? What public schools and public municipalities and states provide are public goods, right? That are non-excludable goods, right? So the dollars that are being spent on educating a child are being evaluated and budgeted based on outcomes for individual children rather than being viewed as collective benefits. So when the state, for example, buys a road, the road isn't generating years and years of revenue for the state directly, right? It helps create jobs and does all sorts of things that aren't measured as positives on its balance sheet, right? So it doesn't get to re-spend those funds. And when we don't measure or account for those sorts of things, it makes it look like they're not doing things efficiently in the neoclassical world or the neoclassical model of how we organize things. And so we really need a much different way of viewing and valuing and assessing what public investment does for us and how it enriches lives and makes the economy better. The cutting of, for example, reading specialists in my district from 8 to 3, right? That's going to be much greater in long run costs for those children's lives in our community generally than the $100,000 that it saves on the budget this year.
Right.
So when we make these narrow sort of value decisions based on cost and benefits, the benefits are never fully appreciated.
Right.
And neither are the true costs of not providing those goods. And this is one of the failures that we're really seeing with COVID-19 and public health, right? The opening up of bars and restaurants, to stop paying $600 in unemployment benefits and to try to reap some sort of revenues from those sales is nowhere near the costs that are being implemented now by having to shut back down, having 11,000 new cases of COVID-19 in the state of Florida, and not to mention the 71,000 nationally, the cost of death and healthcare and all of these sorts of things. So the way that we've narrowed our view of money and how it operates and financing and returns is such that we never really fully appreciate the long-term view, because who has the time, right? I've got to make my payments and settle my debts today. I've got to keep these things moving such that there's no longer-term view as to what we really value and what we really need. And if we, one of the big frustrations that I have with this idea that people are getting the $600 or the stay-at-home orders are so costly. Well, really the government, I think, and us as a populace, as we the people, we owe each other the resources and capacity to do this correctly, right? We've all made sacrifices. We've all lost out on birthday parties for our kids. We've all lost out on graduations. We've all lost out on special moments that we would have celebrated differently. Many of us really enjoy being at work and being with our colleagues. So we're all making sacrifices. We're all taking on costs. We're all doing really hard work, right? We're taking on the health care and mental health cost of social distancing and being in isolation. And so we owe it to ourselves. Really, the state is in debt to us now, right? They should be providing us with the cash flows and the resources that we need to approach a public health crisis responsibly. And public schooling is one of the first places where that responsibility and that provisioning of doing it safely should be erring on the side of generosity,
sure,
rather than the side of being cheap and cost effective, because it is not a for-profit business. And so it shouldn't.
Not yet, anyway.
And it shouldn't be evaluated or accounted for in the same way that Microsoft or McDonald's is.
Well, and I hate to keep asking questions because I know Kin has a lot of great questions he's prepared. But when I hear this, it brings up 2 points. One, I think that in my conversations with people, and again, I'm approaching this as not someone with an economic background like all of you three. So my questions come, from a different perspective. But when I've talked to a lot of people about the economy in general, and we're forcing this idea that we have to get back to work to save our economy, and we talk about these large bailouts that the government has already given to the private sector to try to save the economy. I think the disconnect that a lot of people don't understand is that these bailouts aren't going directly to workers so that they can use these as their salary and their money to stay home and stay safe, which is what other, countries have done when they're looking at implementing the economic recovery aspect of COVID-19. What they're doing instead is giving the money to these companies to give it directly to their stakeholders, to the people who have, hold the stakes of this, and give it to the people who invested and are already wealthy to keep their wealth. So we're bypassing the workers. We're forcing the workers to go back to work, put their life at jeopardy. And instead we're giving the money to the people, who are rich already, who have bought stake within that company to keep their wealth. And I think a lot of people have that disconnect that they think, well, the government's already doing everything they can. They're bailing out these companies and it's not enough. So we need to send our workers back, as opposed to understanding that we're not using this money to pay our workers to stay home, that our economy could still thrive under COVID-19 and we could keep our workers safe if we weren't giving the money to the rich stakeholders and instead we were paying the salaries of the workers. So I think that's a huge disconnect that I have when I'm just having general conversations with people who really, tend to want to keep people safe, but want to prioritize our economy and are worried about that. And that's the first thing. And I know I'm going to throw a lot at you. And then the second thing that kind of comes to mind is, so we're saying essentially we don't have enough money to fund our municipalities through what we're generating, that there's this system created so that we have to take our public entities and we have to intermingle with the private sector. So as voters, as people who care about this, when we're looking at how we change that structure, other than this, you guys and us sitting down to have this conversation, how as everyday voters do we demand a reprioritizing of that? So I know, again, those are deep questions. I don't know who wants to field them, but I just kind of wanted to get them out while they were fresh on my mind. So I'll leave that there.
So I think one point that I want to speak to that is a response to that question and is also a developing of what we've already said and kind of pulling back to your earlier question and comment, Jessica, which was that from a regular person, everyday worker point of view, we work within a budget and that budget is predicated on revenue, right? And what I'll say is that is true to only an extent. And the further up you go in the pecking order of the macro economy, it becomes less and less and less true, such that by the time you get to, large companies and government at different levels, the picture changes radically. And what enables a going entity, whether it's a government or a corporation, to continue is not actually primarily revenue. It's actually access to credit. So whereas revenue is this private, finite thing that you're only trickling in a little bit at a time, and you're trying to kind of squeeze out your budget based on your revenue, credit is a public utility that could be structured in any number of ways. And as the Fed chair is saying, it's actually infinite. So part of the kind of my mental transformation here is to realize, right? This is why Donald Trump is rich. It's not actually because his businesses have done particularly well. It's because he has a brand and he can always get access to credit through his brand. You have so many, public companies that for decades, like Twitter and all these apps, like these delivery apps, who, Spotify, they've gone for years and years and years in the red, right? But they survive because they can create credit, right? But they do that for themselves, for their private profit and their own private advancement. And, that's fine. We can litigate different companies and their behavior and how much public credit we should be giving them. But first and foremost, the residents of Florida should be hip to this and be like, wait a minute, it's my public credit too. And I want that public credit for my school system and for my city and for my county and for my state. And I certainly don't want a balanced budget amendment, forcing these false austerity, so-called hard choices at the state level. That's one place to begin. So I'll get off my high horse and pass it on.
Ben, do you have any thoughts on that?
Yeah, I think, I think a couple words that we should get rid of entirely in our lexicon are taxpayer money. It is not taxpayer money. It is public money. And if we remove that individualist sort of narrative of the taxpayer, right? One of the things that I ask my students is, close your eyes. And when I say taxpayer, who do you picture? Right? They're not picturing people of color, right? They're probably not even picturing women, right? It is a gendered and racialized message that only certain people should be participating or thinking about how we're spending our public money. But if we reframe that discussion and recognize money as a public utility and as a product of, infinite capacity, right, in terms of the monetary side, and we start, it completely reorganizes the way that we think that we want to institute and organize our real resources. It makes transforming our ecologies and the way that we produce our food and our water systems and our healthcare and our education systems, right? Instead of always having to chase capital, we can start chasing labor and start doing some things that are capital displacing job creation instead of labor displacing job creation, right? That whole technological narrative that computers are taking our jobs. This is all part of the same really narrow perspective on what is possible based on finance and returns and the idea that money comes from the market and the state has to take it from the market in order to do stuff. But, the biggest thing that all of us own is the government and the state, right? It is we, the people, and we should be commanding control of that ownership much more strongly than we currently are, right? It's not just about voting. Democracy, we've got a lot of work to do in this country in terms of educating people on how the public sector works and what their responsibilities are as citizens. And we need to lighten the load a little bit in terms of their work and their responsibilities to meet their primary obligations such that we can provide this sort of universal basic infrastructure of health and education and food and housing, so that we can all contribute and live meaningful, useful, and fruitful lives.
Do you guys want to bring it back and talk about the municipal liquidity facility a little bit, and just say how it would work? What would it mean for Hillsborough County to do this?
Looking at the documentation on the program and everything else, certainly, first of all, it's a limited program as far as time-wise. So if a municipality is going to be involved, they've got to get involved now. For them to participate, they have to have certain ratings, and they have to be able to issue some kind of an instrument, whether it's a bond or whatever, to be able to do that, correct? So, I would advocate that if this is a good way for us to help get the monies back into those entities, that we're going to have to move quickly. Those things, issuing bonds or don't happen overnight. They take time. So maybe y'all can address some of those issues or some, that at least that's my perception of what I've read about the program. Is that correct? I guess first question.
Yeah, you're on track. The Hillsborough County, I believe, already qualifies as a revenue bond issuer, but also as a relevant size county and population-wise, et cetera. So they can issue debt in the amount of 20% of their 2017 total revenues. So, in the state of New York, that comes to something like $18 billion. In the city of New York, I think it was $15 billion. And 20% of the 2017 revenues is roughly what many of these states and municipalities are estimating as their budgetary shortfalls based on the crisis. So if you issued in that amount, right, you would get the cash flow that meets the shortfalls of the existing crisis. And yes, I think that the terms and the conditions and the cost of the borrowing are not ideal, right? And this is something that a lot of people are writing about right now in the financial literature. But you can only adjust those terms if you begin to act. Second, I would say that if you don't start filling those gaps in your budgets, right, the cost of that is like trying to treat COVID-19 with aspirin or Tylenol, right? It's a marginal, you're just barely treating maybe the symptoms, right? You take some Zyrtec because you're coughing. That's not going to do it. And you're setting yourself up for, the long-term, really extreme health crises, right? Ventilation and potentially death. So, we need to get the proper treatment, right? The cash flow that you need, the medical liquidity that is required to keep our states and municipalities functioning such that we don't devolve into, the sorts of food lines and soup lines and Great Depression era sort of crisis that, my grandfather lived to be 97 and was born in 1922, I believe. So he talked about the Great Depression till the very end, the Great Depression and World War II. We don't want to live through that. Right? We don't want this sort of life-scarring event for our kids and our families. This is an intergenerational moment that issuing bonds and sorting that problem out is an immediate move in really transforming public high finance, I think, permanently, right? The facilities didn't go away after 2008 for the banking sector. There's no reason to believe that the terms and conditions in these facilities at the municipal level should go away. As, if anything, they should probably expand and grow to hit better targeted areas, right? A municipal liquidity subdivision that is specifically designed to support school districts, for example. These are the sorts of innovations and ideas that we should be throwing at our legislators and our Congress people and our local leaders saying, throw out your playbooks. They're not working. Let's start doing some different things to make sure that we don't end up in a depression with a global health pandemic on top of it.
So, sorry.
Go ahead.
I was like, I'm going to be quiet during this interview and I can't help myself.
Yeah, right.
So what I'm understanding, and again, I'm always trying to break this down, from another perspective, from the average voter's perspective, is we are talking about, because Hillsborough specifically, we've been volleying back and forth between, nationally and Hillsborough, but Hillsborough specifically already has a $50 million deficit just on this year, not including, that's just from mismanagement. That's not even including talking about the deficit we're going to have from the state legislation when we're talking about next year's budget and the effects of COVID. So we are talking about federal programs that they're offering right now to offer money to different municipalities as loans to recover from some of the losses or to give them money from some of the losses expected from the state legislation and other forms of revenue locally that they have. My question is, with this, so essentially, are we borrowing more money? Are we looking at the money we've already borrowed and exchanging it for this money? If we're looking at borrowing additional money, what happens when we have to go and pay that back? If we're already operating from a deficit and we're borrowing more money, even if the terms are lower, and then when we have to go to pay it back, the percentage rate is less. How does that fare for us in the future? If we don't have enough money, we're expecting a shortfall, we're borrowing more money. At what point do we start to level out where it's, as you've mentioned, it's not just a constant money borrowing? And as Scott had said, is this something that we're hoping that at one point the federal government might start to forgive some of these loans? Is that why this might be a better choice for voters or for Hillsborough County or municipalities? Because at some point we're hoping that, maybe with the switch of the presidency or whatever could happen, we might have someone who's more open to forgiving some of these loans. So help me understand why, everyday voters in counties that are caring about the municipalities should value these loans as opposed to where we're already borrowing from.
Well, because the Federal Reserve has an infinite capacity to hold these loans on its balance sheet forever, where the private market doesn't.
Okay.
Right? So, if you look at the purchase of mortgage-backed securities at the beginning of 2008, the idea was that this was a short-term liquidity fix. The same sort of language that they're using around the Municipal Liquidity Facility was used then. At the beginning of the mortgage-backed security purchases, it was, like I said, somewhere between $1.3 and $1.8 trillion. Right before the COVID-19 crisis hit, the dollar value of mortgage-backed securities on the Fed's balance sheet was about 1.6 trillion, somewhere around there. Right, so almost no change. So they have the capacity to hold these assets on their balance sheet in perpetuity. And this isn't a radical political economist interpretation. This is former Fed Chair Ben Bernanke's assessment of why non-standard monetary policy operations, essentially the quantitative easing that they developed, would work, right? If the Federal Reserve is credible in being able to hold these assets on its balance sheet, then that is what returns confidence to the public.
So could you say it's like deciding between borrowing money from like a friend who needs it back by next Friday or your rich uncle who, might not need it back in his lifetime? Is that kind of an analogy, or is that way off base?
No, I think that's, if that's how the voter understands it, I think that's fine. Uncle Sam can hold it. Uncle Sam can hang on to these assets forever. And the idea that the Federal Reserve would open the liquidity facility to stopgap a financial crisis for cities and municipalities, and to think that they would have some sort of demands for principal and interest, and at the end of the terms of the issuance, if we're still in a crisis and these cities and municipalities hadn't recovered, defeats the purpose of the facility to begin with. So it feels scary, right? Because the terms and conditions laid out by our friendly banks in our communities are terms and conditions that they will stick by. But the Federal Reserve is, they call it plasticity of the balance sheet, right? It is very much manipulate. They can manipulate it not only in what they're holding on the balance sheet, they can manipulate the size of the balance sheet, and they can manipulate the time frame of what they're holding on the balance sheet at, in the words of Neil Kashkari, at an infinite capacity. So I think that's the really big difference there.
I just need to let you guys know we are beginning to run out of time. And this is a fascinating discussion. I would really love to try to put this back together some other time to have even further discussion about this. But we are beginning to run out of time. So, Scott, if you can just briefly let us know what your thoughts were, and then I'm going to ask you guys to kind of give us a synopsis of this program and why, as a voter, why should I support people who support this?
So what I was going to say was, literally the terms, the words that we use to talk about what the Fed is doing right now and offering right now are up for grabs, right? And they're really political. And, we're recommending that Hillsborough County and the city of Tampa, and quite frankly, all municipalities and states in the country take advantage of this, and take advantage of this in the face of a feckless federal legislature that isn't doing enough for us. What is called a loan versus a grant gets very slippery when we're talking about these Fed programs. And just to spell out in other, maybe layman's terms, what Ben was just talking about is that, essentially the Fed has given out trillions of dollars in loans over the last 10 years and no one's paid them back, right? So the idea that we wouldn't take advantage of something that's being offered to us because we're afraid of a kind of later political reckoning is to cower in the face of the challenge before us.
Yeah. So not paying back your loans. Another way of thinking about it is that remember the Fed bought those assets, right? They gave the banks cash for assets that were zero, right? They had no value. In fact, banks couldn't wait to get them off their balance sheets because it was preventing them from doing any sort of business or operations to begin with. So essentially, the Federal Reserve did a humongous, $1.8 trillion cash drop on the banking sector. So when people say, well, what about inflation? There's, by the textbook, no better way to create rapid inflation than just dropping cash that doesn't create any additional or new value on the economy. And that's exactly what the Fed did. And we remained in a devaluating, deflationary period for the next 5 years. And the Fed still is doing these things. Massive quantitative easing, cash drops throughout the economy. And it can barely hit its inflation target of 2%, right? Think about if these sorts of cash drops are being done in order to open schools safely and to provide public education and to rebuild our infrastructure. Those are direct value creating activities, right? So why would, if non-value creating activities don't create inflation, why would this, right? We would be activating and keeping people busy and doing work and producing real goods and services that people would be enjoying and using. So, I think the voters should be voting for a doctor that wants to treat the economy for the disease that it has instead of just passing pills to treat symptoms. Is the basic way of arguing for this. And that, healthcare is a lifetime endeavor. And so we need to treat the disease now so that we can continue to fight disease and be healthy for a lifetime. And so we need to take a much longer view of what the economy is and what we value. And if we do that, then we'll be much better off and we'll elect much better politicians and will use money as the public resource that it is much more effectively rather than limiting it to efficiency.
Why haven't more municipalities jumped on this? What is the pushback, Scott? When you're saying you've brought this to the city of Tampa and it falls on deaf ears, what is the pushback? Why do you think, if this is such a solution to what, we're facing right now, and we have such a powerful argument for it, why is it not catching on more? What is the pushback? Why aren't municipalities and other governmental agencies taking advantage of this?
Oh, for the record, I've written the county, but I haven't written the city yet. That's going to come. I've deaf ears. I've
the
heard
county,
nothing.
sorry.
I've heard nothing. I think it's because of an austerity mindset that we've been talking about this entire episode. And
Can you break that down a little bit more when you say that for listeners who don't understand what that means?
Yeah, I think our public officials are used to thinking of the operations that they oversee as being having to work to do a lot with very little money. And
Gotcha.
In a crisis, they feel like they absolutely have to do less. And they don't want to take risks. Who take risks are all our donors, because they're taking big risks in business and in finance, and they'll go to the Federal Reserve because they're the risky ones. But we're not really too innovative, or we're not really willing to really put ourselves out there. So I think that's why you're only seeing the state of Illinois, the port authorities of New Jersey and New York, and the MTA in New York petitioning the Fed. I also think a lot of this is happening around New York because the New York Fed board itself is running all of this stuff. So I think there's probably just more like mingling, just like people who know each other in elite circles.
Sure.
That means that they're more plugged in to what's going on with the Fed. Whereas, I mean, honestly, this is like the $1 trillion question to me. It's like, are these leaders this freaking clueless, right? Or are they being asked not to use it so that Republicans can push long desired deeper cuts? I mean, I don't really know the answer to this, but I do know that it's up to progressives and the public and people like you running for office to raise awareness so that we can get ahead of this rather than be treated as victims.
Thank you.
Yeah. Humans are habitual, right? This is outside the playbook. And so people don't know how to respond or what to do yet. And there's been some good writing about why having it just be at the New York Fed is a bad idea, right? It should be at all the regional Fed banks, so that there is more conversation and understanding and distribution of how these resources should be allocated, because the regional banks all understand their regions much better than the New York Fed does. So there's lots that can be done here to improve this situation. But I do think it's easier to fail conventionally than to succeed unconventionally. And so that, I think, is an unfortunate reality that we're fighting against.
I think you said it very well there with your last comment. A lot of times I don't think people are willing to make the change that would help them be successful. And unfortunately, that's the situation I think we may be facing. But I want to thank you guys profusely for coming on. This was a very, very good discussion. In fact, kind of open invitation to both of you to come back in and discuss a lot of this further. We can again give some time to do that. Certainly, I would be willing to do that and try to get this because I think this is an important discussion that we need to get into the public sector. How are we going to go forward after this crisis and not find ourselves in the kind of recession that we had in 2008? And how can we do that and recover much quicker from what's already happened? So, Jessica, is there anything else?
No, thank you so much for having this discussion, for making yourselves available. I mean, I think I agree that it feels, like our elected leaders are just not able to be innovative and forward thinking because they're so used to constricting themselves to these very narrow guidelines of what they think they need to do to be elected. And then once elected, it's just a play towards partisanship. And this just really illustrates so many systemic problems we have and how we need to start trusting bold, new, innovative leaders who you say are willing to risk taking chances and putting the time into educating their constituents and really surrounding themselves with the people who are experts in this field and can help us kind of dig our way out of all these problems that our institution has created. So I really appreciate the time and the energy of putting this together. I agree with Kin that this is something that we need much more conversation about, and I would love to have a second interview or a podcast episode about this if you're available, or other things that aren't necessarily related to this, because we're just starting to wake people up to the idea of MMT and these different thought processes that revolve around economics and how we've, as you said, been kind of trained to think about our economy and capitalism and what's working for us. So again, I thank you for your time. I thank Kin for pushing this forward, making sure this happens. He's really kind of been the guiding light to push these podcasts out since I've been so busy on my campaign. And we just all have to keep doing the work. As you've mentioned, it's a huge amount of work to educate people and stay ahead of things, because every time it seems like you've figured something out, the rules change and the game changes, and people who want to take control or have the power kind of alter the facts and the narrative, and you have to kind of stay ahead of that. So that was my soapbox moment there, and I'll defer it back to you, Kin.
Very good, and thank you, Jessica, Ben, and Scott. Thank you again. Just like to say to our listeners, thank you for listening in on this conversation. And with that, we'll say goodbye, at least until next time.
Aww.
Thank you so much.
Thank you
so much.
Thanks for having us.